Typical controls related to cash are segregation of duties. That's the big one. Again, that's where we make sure that the tasks are split up amongst people so that key functions don't overlap, so that an individual doesn't have the ability to set up a vendor, uh, input an invoice, approve that invoice for payment. So those are key areas that we separate amongst employees to try to get some control related to the cash. Another one is positive pay. What positive pay is after the checks have been approved for payment and cut for payment, a file is delivered to the bank. It usually has just the check numbers and the amounts on it. So that if anyone tries to steal that check and divert that check, increase that amount, anything like that, it will bounce out in the bank system and say they can't honor that check. For an additional fee, you can actually get it at the payee level, meaning if they do white out a name and put another name on it, that bank will identify the fact that, oh, that's not who that was the intended payee on that check, so they'll bounce that also. There's also computer controls and edit checks within systems now that help prevent diversion of cash, and even a lot of times the online banking won't allow you, without special rules, to be able to do money moves to other companies outside of what you control in your bank account. Authorizations. Authorizations approvals of the check runs. You could also have workflow approvals so that when invoices come through and it hits certain levels of the volume or actually dollars, and a manager might be able to approve that. If the dollar amount is higher than that, then maybe his superior would need to approve it. But usually it's set up in the system, again, like a computer check, to authorize that payment for release. You could also have EFT agreements, electronic fund agreements, that are out there that are authorizations that are allowed to then move money to different accounts or create auto pays for like your electric bill or whatever to move money out of the cash account. You should have procedures around doing bank recs, procedures around disbursements, things like that, so that everyone is very aware of how the process of cash coming in and cash going out and that reconciliation happens. Pre-numbered documents are another key control. Check numbers. One of the things you want to look for are missing checks, or gaps, I should say. And if you got 1, 2, 3, 4, and then all of a sudden you jump to 23, 21, 22, what happened to those checks that are missing? You will also do that for invoices and POs and things like that, so that you have pre-numbered items out there so that you'll always be, whether it's cash cycle or other cycles, you can keep track of things. So pre-numbered documents are a good control. The employees, you want to have good, competent, trained employees that know what they're doing so that they can both be efficient and effective in both doing their work and identifying any problems that happen. And then you want a periodic review, or if the company's large enough, an internal audit. When it comes to typical controls for petty cash, you want to make sure that you have a written policy and you're applying those procedures on how it's both replenished and how it exits out to individuals who are using it. So you want to limit access to that petty cash, whether it's in a locked box in someone's desk, or it's in a vault or some sort of storage that makes it very difficult for others to have access to it. You need receipts for anything that comes out of that petty cash, and then those receipts are used to put together replenishment requests. So the checks that are written to replenish that cash should have the detail and all the receipts associated with that replenishment, and they should add up to total that check that's used for replenishment. And finally, you got to audit the petty cash. So you want to do a surprise audit once in a while to make sure the individual in control of that is doing all their tasks properly. When it comes to cash, some of the analytical procedures you should do are comparing cash balances with past years and budgets. It's amazing how, if you trended out the monthly cash flow from one year to previous years, you'll see patterns that are usually very similar. But you'll want to identify unexpected spikes or lows during the year and understand what they're comprised of, and do they seem reasonable. You're going to compute trends and estimates on interest returns. Are they what you expect? You'll analyze those cash balances against debt loans or covenants to make sure that we haven't slipped below the requirements that could potentially incur penalties or even potentially loss of that credit line. You're going to compute cash related ratios like the quick ratio or the current ratio, compare it to industries, compare it to prior years of that company. Do they make sense? You'll graph the cash balance changes against profitability. So it only makes sense that if we're becoming more profitable, then theoretically our cash should go up too. Obviously, there could be differences in cash collections because of timing and accounts, whether you've got credit sales on accounts receivables and maybe there's been problems paying. And so that may be some differences in it. But in general, you should see cash balance changes kind of go similar in a graphing standpoint to profitability. So indicators of possible fraud when it comes to cash are unusual large cash transactions, especially unexpected unusual large cash transactions. You're also going to again look at cash flow related to profitability, and if there are some significantly different patterns that don't get explained through collections, then that's something you want to investigate. Are consistent profits happening, but cash flows are in the decline? That's a problem. Unexpected increases in petty cash or unusually frequent replenishments of that petty cash. Reductions in accounts receivable collections while sales are stable or growing. So, is there a problem with the industry at that time, or is it something related to that cash collections that's a problem? If there are significant changes in cash flow compared to prior years. And then finally, if there's just a lot of increased transfers, especially to unfamiliar or unexpected accounts.